putting the general election campaign and Brexit to one side, we've got a busy week coming up. Top down, the major feature will be the latest UK unemployment and wage growth figures on Tuesday the 12th of November, and straight after them we'll get the inflation data on Wednesday the 13th. The key here is whether pay increases continue to outstrip increases in the cost of living. If so, that should be good news for consumers, possibly consumer-related stocks, as it puts more cash in real terms in purses and wallets. However, if wage growth blows too hot, unlikely as that may seem right now, that could persuade the Bank of England to consider a third interest rate increase for this cycle. Although, given Brexit and the uncertainty surrounding global trade, such a policy decision again seems unlikely for the moment. Anyway, just to remind you of the last sets of data, in August, the unemployment rate came in at 3.9%, up a fraction from 3.8% the month before, and wage growth reached 3.8% year on year, including bonuses. Now, one stat that may just be worth watching is the number of job vacancies. This peaked in January at 861,000 and has since dipped to 813,000. May suggest the economy is slowing down a bit. Meanwhile, to go to the inflation figures, well, they were as follows last time around. 1.7% on the Consumer Price Index, or CPI, 1.7% on the Bank of England's CPIH index, its preferred measure, which includes housing costs, and 2.4% on the Retail Price Index, or RPI. Now, in this second graphic, we can see how wage growth compares to CPI inflation. And then in this third one, we can see how real wage growth, inflation adjusted, compares to the FTSE All-Share General Retailer sector. Now, I know I've flagged this one before, and we must also accept that correlation does not equate to causation, but it may not be a coincidence that for all the gloomy high street headlines, the general retailer sector is fifth best performing out of 39 in the FTSE All-Share in this year to date, with a gain of more than 20%. There's also a full slate of scheduled corporate announcements awaiting us as well. We've got about 15 FTSE 100 firms due to republish interim or full year results, release an update or host an annual general meeting. And for good measure, a number of small and mid caps are primed to do the same. They include Burberry, engineering software specialist Aveva, National Grid and real estate investment trust Great Portland Estates on Tuesday the 12th of November. Another REIT, real estate investment trust, British Land, as well as house builder Taylor Wimpey, utility SSE, Smiths Group and One Savings Bank on the 13th. Yet another real estate player, Land Securities, plus Meggitt, ITV, Experian and DCC on the 14th. And Informa, bookmaker William Hill and troubled funeral service provider Dignity on Friday the 15th of November. But the company which could cause the biggest fuss in the week ahead might just be telecommunications giant Vodafone. It's due to release its first half results on Tuesday the 12th of November. Now, as you can see in this next graphic, Vodafone's shares have given investors a bit of a roller coaster ride over the past 12 months. And actually, they stand no higher now than they did in 2010. Intriguingly, the share price bottomed in late spring when new-ish boss Nick Reed sanctioned a cut in the annual dividend from 15.07 to 9 euro cents a share. Since then, it's rallied and rallied hard, and I guess there could be three reasons for this. First, the dividend cut could just be seen as getting some pretty terrible news out of the way and making sure the worst is behind us. Second, Mr. Reed's made a particular point of targeting better returns from the company's infrastructure assets, such as its mobile network towers, and some suggest he may even look to partially spin those off. Vodafone's also restructuring its portfolio via the sale of New Zealand and a merger in India. Third, Vodafone has already made announcements about network sharing, notably in Italy and Spain. That should lower future investment costs, especially relating to fifth generation or 5G networks, and lower capex means more cash flow, which may mean safer dividends. Now, all of these moves are designed to bolster cash flow, and yes, it's that cash flow that funds the all-important divvy, and more of that in a moment. Management has offered two pieces of guidance for the full year, So when we look at the interims, analysts will be homing in on those in particular when they look at the first half results. First, management's guidance for underlying adjusted profits of between 13.8 and 14.2 billion euros. That compares to 14.1 billion last year, based on this metric of adjusted EBITDA, or earnings before interest, taxes, depreciation and amortization. The forecast also implies low single-digit percentage growth on an organic basis once you adjust for changes in the group structure. Secondly, look at management's guidance for free cash flow of at least 5.4 billion euros before, note, before spectrum costs. That implies a flat figure on last year's 5.4 billion euro outcome when, for the record, spectrum costs came to 1 billion euros. That then takes us to the dividend, which is still paid in euro cents. After last year's cut to 9 euro cents, the first ever reduction in the company's history, Vodafone is looking to redevelop what it calls a progressive dividend policy. Now, the consensus forecast is for the full year number to come in pretty much flat on last year, and that would imply a cut to the interim figure from last year's 4.84 euro cents a share. It also would put the shares in a dividend yield of around 5%, although do note that earnings cover still only around 1.1 times, so Vodafone's got plenty of work to do if it's to rebuild that towards the much safer level of 2 times. This chart, by the way, shows the dividend progression in pence. With regard to the 2 final points, Vodafone launched 5G services in the UK in July, so watch out for any commentary on that. And also look out for commentary on the 18.4 billion euro acquisition of Liberty Global's cable TV assets in Eastern Europe and Germany, which regulators finally passed during the summer. That means that Germany is now a more important market to the company than even the UK. Thank you for watching, and I look forward to seeing you next time.